Today, we are diving deep into the financial and physical reality of the AI boom, and this is custom tailored for you. This isn't just about valuations. We are peeling back the layers on these massive, really complex financial structures and the deep market anxiety that's underpinning it all. Okay, let's unpack this. Our source material today is frankly extraordinary. It's forcing us to look at how tech giants and the startups they fund aren't just raising capital. They are actively building these immense financial fortresses. We're talking billions flowing into highly specialized debt structures. And that reveals just how much stress is being placed on global capital markets to keep pace with the sheer computing demands of AI.
Our mission here is really to connect these threads because they might seem separate, but they're not. We'll start by analyzing why tech startups have suddenly amassed this collective war chest of $150 billion. Then we have to trace that staggering flow of capital directly to the physical world, specifically the controversial $120 billion in data center debt. And finally, we have to connect that high-stakes financial risk to the next big thing on the horizon, the quantum revolution, and its promise of, well, instant obsolescence. It's a study in speed versus fragility.
Okay, so let's start with that money. The money just sitting on the sidelines. We're talking $150 billion in cash reserves held by tech startups. In a market where capital is supposedly chasing every decent AI idea, why are founders just sitting on this gigantic stack of cash? Why the hesitation?
It's the ultimate defensive strategy. What we gathered shows that founders are explicitly building what they are calling fortress balance sheets. They remember the historical cycle. They fear an eventual and likely pretty painful AI investment bust. And they're watching the public markets very, very closely, which are already showing, hostility and skepticism toward smaller, younger companies.
Companies that are growing fast but have no real clear path to profit on their own.
Exactly.
So this cash, it's an insurance policy. If the funding taps suddenly dry up, this buys them the freedom to keep operating without bowing to short-term investor demands.
It's so much more than insurance. It's immense leverage. I mean, think back to the dot-com bust. The companies that had cash on hand could simply wait out the market correction, or more strategically, they could buy up distressed assets or talent at bargain bin prices. This $150 billion war chest means today's AI companies can buy time to perfect their technology. And more practically, they can secure long-term computing resources from the big cloud providers. They get powerful negotiating leverage for talent, for data labeling.
So they're insulating themselves, but also preparing to be the last one standing.
That's the goal.
And what's really interesting here is the source of this funding. It's not just venture capital anymore, is it?
No, not at all. It's highly concentrated and very strategic. The scale is just breathtaking. We're talking about OpenAI's valuation soaring toward, $80 to $100 billion, and Anthropic recently completing a staggering $7.3 billion funding round. But the crucial detail, the thing you have to watch, is who is writing those checks. So much of this capital is coming directly from big tech, from Google, Microsoft, Amazon.
Wait, hold on. So if Microsoft is funding OpenAI and Google is funding Anthropic, are they really just creating partners? Or is this something else? Are they sort of subtly controlling the future narrative and the whole supply chain of AI innovation?
That is the core tension. I mean, the analysis really points to big tech using these investments to secure access to cutting-edge models. And often they're locking in these exclusive computing partnerships. It lets them outsource the most speculative, high-burn R&D.
While making sure the final product drives demand for their cloud services.
Precisely. It's control by funding.
That concentration of wealth, the high valuations, $100 billion for a company that's still fundamentally scaling it, naturally brings up the word bubble. So is the consensus in the reports that we are heading for another 2000-style collapse?
This is where that necessary nuance check comes in. The consensus argues this is not a classic bubble.
Okay.
Because the underlying technology is demonstrably real. It is already generating concrete, measurable revenue for hardware and cloud providers. The demand for GPUs, for instance, isn't speculative vaporware, it's real.
The concrete.
But, and this is a massive caveat, the valuations are extremely high, particularly for those late-stage companies. The market is wary of those high expectations and those, frustratingly opaque profit paths. We are witnessing a genuine technological revolution wrapped in just extraordinarily speculative investment.
That distinction, real tech, speculative pricing, that's vital. Okay, so now let's follow the money to where it has to land, the physical world. AI models need these enormous, power-hungry data centers. And this is where it gets really interesting for me. How are these tech giants actually paying for all this? It's not just equity anymore. They've turned to specialized debt, and a massive amount of it.
It's a massive leveraged backstop for the AI dream. I mean, we're talking about AI groups leveraging data center assets using up to $120 billion in non-recourse debt deals. To do this, they don't issue the debt from their main corporation. They push it through these structures known as special purpose vehicles, or SPVs.
Okay, let's stop there. For you listening, let's go beyond the acronym. Why is the SPV the critical mechanism here, and why is it suddenly being used at this massive scale?
Right. So think of an SPV like building a completely separate legal house just for the data center project. If the roof leaks, or in this case, if the data center fails to generate the revenue you expect, the bank can only claim that specific house.
Not the main corporate mansion. Not the core Meta or Oracle balance sheet.
Exactly. It's a firewall. It allows companies, and this includes big players like Meta, Oracle, and even infrastructure groups like Shell and Modi, to isolate the debt. It lets them transfer all that project-specific risk directly to the lenders who are holding that non-recourse debt.
So the core companies are shielded, but the risk just gets shifted onto the big banks and the private credit firms. But given that AI demand seems endless right now, why are those lenders suddenly getting nervous about this $120 billion?
Because the risk profile is unique and it's terrifyingly concentrated. Lenders are facing two major anxieties. The first is what they call hyperscale demand risk. What happens if the demand for specific types of data processing, say, training gigantic foundation models, what if that slows down?
Or if a major client just decides to bring their capacity in-house?
Right. Then this highly specialized data center asset, which was purpose-built, suddenly struggles to find another tenant.
And the second anxiety is, it's the very theme we started with, speed. The risk that the collateral itself just becomes worthless almost overnight.
Exactly right. The collateral underpinning that $120 billion in debt isn't just the concrete building, it's the specialized computing equipment inside. The racks of GPUs, the cooling systems. If that equipment becomes rapidly obsolete due to the relentless speed of tech advances, which is a very real possibility in AI, the assets could be devalued from billions to near zero. That concentration of $120 billion of debt, all tied to highly specialized, quickly aging technology, that is the core systemic concern for the financial players.
That's a powerful connection. The AI boom is riding on a massive amounts of debt that is uniquely sensitive to the speed of innovation itself. And that debt structure raises the biggest question: what makes an asset obsolete? That question takes us out of finance and into pure physics. So let's shift gears completely. Let's look at a radical innovation that promises to accelerate that obsolescence faster than anyone anticipated. We're moving into deep tech, the new quantum revolution.
And this is where science fiction becomes a genuine financial threat. The key material driving this revolution is something surprisingly familiar. It's synthetic diamonds. Scientists are deliberately engineering tiny flaws into these crystals. These flaws are called nitrogen vacancy defects, or NV defects.
An imperfection that creates a pathway to a massive technological leap.
Precisely. It's really elegant physics. They just replace a carbon atom with a nitrogen atom right next to a vacant spot in the lattice. And these NV defects aren't just scientific curiosities. They act as quantum sensors or potentially as very stable qubits.
We're talking about ultra-precise measurement and computing. What is the commercial timeline here? When do these microscopic flaws start impacting the larger world?
It's immediate. The source material really emphasizes that this technology is rapidly leaving the pure physics labs and entering commercialization. We're seeing it in areas spanning ultra-precise medical imaging, advanced navigation systems that can't be jammed, secure cryptography, and of course, computation. And critically, because these NV defects act as quantum sensors, they promise leaps in sensitivity that could fundamentally change how we measure and control things like magnetic fields, which is essential for stable quantum computing.
And this is the direct link back to our $120 billion problem. If quantum computing advances rapidly, maybe enabled by these diamonds, it could make the massive silicon-based data centers we just financed obsolete in a geological blink of an eye. The speed of the breakthrough makes the debt risk immediate.
The convergence is unavoidable. If a breakthrough means that traditional GPU clusters can be superseded by some new, power-efficient, quantum-accelerated technology, then that highly specialized $120 billion collateral instantly depreciates. That is the technological shockwave that keeps the lenders up at night.
Okay, let's connect that rapid transition from physics to commercialization with some global strategic shifts in energy. It's almost a perfect illustration of two ships passing in the night. One ship, the established energy sector, is dramatically lowering its anchor. The other, the next generation of green tech, is raising full sail. I mean, look at China's strategic move in clean fuels.
China is making an extremely aggressive, forward-looking strategic play. They are leveraging their existing massive advantages in green tech, their global lead in solar and wind, to drive the conversion to clean fuels. The analysis highlights their intense focus on massive-scale green ammonia and green methanol production. This isn't just about reducing domestic pollution, it's about reducing dependence on volatile fossil fuel markets and cementing their control over the future green supply chain globally.
And you contrast that with what the sources show is happening in, the historic powerhouse of the North Sea oil and gas sector.
Well, the North Sea is facing a profound structural decline. The data shows exploration spending is at an all-time low. Companies are spending less on finding new fields than they have in decades. And this dramatic pullback is specifically attributed to two things: a high tax take by governments and this persistent uncertainty over future profits.
Which leads them to redirect capital somewhere else entirely.
It's a clear strategic disinvestment in traditional energy.
So we have the immense financial structure of the AI boom, the potential for a quantum shockwave, and these huge global energy shifts. But all of this is playing out against a deeply fragile global economic backdrop. Let's connect the tech boom to two massive underlying global stressors that threaten long-term stability. First, the demographic crisis in Japan.
This is a profound, slow-motion disaster. It impacts everything from consumer markets to labor supply. Japan's birth rate is on track for a record low. Estimates are showing 2023 births were 5.6% lower than the year before, and the numbers are just staggering. By 2035, roughly 20% of Japan's population is projected to be aged 75 or older.
And the consequence is far beyond just Social Security. It impacts productivity, investment appetite, labor costs globally.
Absolutely. A shrinking, aging workforce means higher labor costs, lower domestic consumption, and a greater strain on public budgets just when global capital markets need stability. It completely undercuts the economic buoyancy required to support speculative tech investment over the long term.
And the second major stressor is the fiscal crisis brewing inside China's local governments. Historically, they relied so heavily on land sales for revenue, but that income has, well, it's evaporated.
It's fallen off a cliff since 2021, and that's left enormous immediate budget holes for local governments across China. They are now in a frantic, desperate scramble to monetize whatever state assets they can, properties, shares in local firms, anything, just to find stable revenue. This creates deep uncertainty about fiscal stability and the government's ability to guarantee long-term contracts. And these demographic and fiscal pressures, they really highlight the deeply fragile environment in which these massive high-risk AI debt structures exist.
It really paints a picture of intense innovation and financial daring overlaid on this immense, slow-moving structural risk. Before we wrap up, let's just offer two final market niche takeaways that show the fight for margins happening elsewhere. First, the growing hotel wars.
This is a fascinating fight for direct control over the customer. Major hotel chains, Marriott, Hilton, Hyatt, are dramatically increasing their bets on direct bookings. They're pouring money into loyalty programs, unique perks, anything to try and bypass the online travel agents, the OTAs, entirely.
And why the drastic action? What's the cost of that middleman?
The cost is enormous. OTA commissions can eat up to 25% of a hotel's revenue on a booking. So if you are running thousands of hotels worldwide, cutting out that 25% fee is a major, immediate operational gain. It's a huge competitive advantage.
And they're using things like free breakfast to change our habits.
Exactly.
And finally, a quick look at a market that is definitely not experiencing a boom. Fine wine.
Yeah. The fine wine market has been struggling. Prices have been falling consistently for 3 straight years. The steepest pain has been felt by mid-cap and smaller wine regions, which are more susceptible to economic slowdowns, changes in discretionary spending. But what's interesting is the resilience at the very, very top. High-end Bordeaux has managed to hold up relatively well against the broader slump.
Which just shows that the ultra-wealthy buyer often remains insulated from these trends.
Yeah, it's a different world.
This has been an absolutely essential deep dive. We've explored the strategic financial engineering of the tech world, starting with those $150 billion fortress balance sheets designed for defense. We traced that anxiety into the risky, highly leveraged $120 billion SPV debt structures financing AI infrastructure, and then saw how the groundbreaking science of quantum diamonds could trigger a wave of instant obsolescence.
You know, what stands out when we synthesize all of this is the sheer intensity of the financial engineering needed to keep the current AI boom afloat. And this high-risk construction project is unfolding at the same time the global economy is facing these deep-seated structural challenges, from demographics in Japan to fiscal strain in China. It is a precarious balancing act of speculation versus reality.
And that brings us right back to our nexus of risk and speed. So, final thought for you to take away. If the exponential pace of the quantum revolution means that today's cutting-edge, specialized AI data center gear, the very hardware that underpins that $120 billion, becomes obsolete faster than anyone anticipated, who ultimately bears the risk for that massive pile of infrastructure debt? If that separate legal house is suddenly worthless, who takes the loss? Something critical to think about as you navigate the news in your investment decisions this week.